The monetary revolution, from gold, Bitcoin to Pi network. The future of finance in your hands is money? Is it the paper in your wallet, the numbers on your screen, or the gold bars locked tightly in a vault? For centuries, humanity has grappled with this question, constantly reinventing how we exchange value. But what if I told you that the biggest monetary revolution is happening right now? Not in banks or government buildings, but right in the palm of your hand. Welcome back to Pi from Us, your channel dedicated to the deep dive into the world of cryptocurrency and the future of finance. And today, we're embarking on an epic journey together. A 5,000-year saga condensed into one video. We'll explore the secrets behind currency, expose the flaws in the systems we trust, and reveal why projects like Bitcoin came into existence. More importantly, we'll discover how Pi Network, the project Pi from Us champions, isn't just another cryptocurrency, it's the culmination of this long evolution, a potential solution designed for everyone. Follow me, because understanding this history is key to grasping the incredible opportunity that Pi represents. We'll travel from ancient barter and glittering gold to the complex, sometimes baffling, world of modern banking. We'll witness the fall of empires built on gold, and the rise of digital currencies born from code. And finally, we'll land on Pi Network, how it works, why it's different, and why we believe it's the future. Prepare yourselves, sit back, and get ready to change your perspective on money forever. Don't forget to hit that like button and subscribe, so you don't miss our future explorations. Part 2, from barter to gold. The search for stable value. Imagine you need bread, but all you have are chickens. You need to find someone who wants chickens and has bread ready to trade. Sounds inefficient, right? That's barter, the earliest form of exchange. While it worked on a small scale, it had huge limitations. The problem of the double coincidence of wants. It's hard to find someone who both wants what you have and has what you need. Early societies were creative. Cattle, grain, salt, tea, even shells like cowrie shells were used as commodity money items with intrinsic or agreed upon value. But they weren't perfect either. Hard to divide, perishable, bulky. For example, in Brazil, people once used cowrie shells brought by Africans, brazelwood, sugar, cocoa, tobacco, and cloth for exchange. Then came metals durable, divisible, portable, and often beautiful. China used bronze coins shaped like agricultural tools, while in Lydia, modern-day Turkey, around the 7th century BC, the first true coins emerged, standardized pieces of metal, often an alloy of gold and silver electrum, stamped by the government to guarantee weight and purity. This made trade much easier. King Aliats of Lydia is credited with minting this first official currency. Fast forward to the 19th century. Many nations sought even greater stability and adopted the gold standard. This wasn't just about using gold coins. It meant their paper money was directly backed by gold reserves held in treasury vaults. In theory, you could walk into a bank and exchange your paper notes for a fixed amount of physical gold. Why was this considered a golden age? Because it promised stability. The amount of currency was tied to the amount of gold a country possessed, limiting the government's ability to arbitrarily print more money and cause inflation. It also created fixed exchange rates between gold standard countries, simplifying international trade. Great Britain stumbled into a de facto gold standard in 1717 when Sir Isaac Newton, then master of the Royal Mint, set the ratio of silver to gold to low, causing silver coins to disappear from circulation. As Britain became the world's leading financial and trading power in the 19th century, other nations increasingly adopted its monetary system. But even before the formal gold standard, paper money had ancient roots. China invented it as early as the 7th century and used it widely by the 11th century under the Song dynasty. In Europe, it evolved differently. People deposited their gold with trusted goldsmiths for safekeeping. These goldsmiths issued receipts for the gold. These receipts were convenient, much lighter than carrying gold. Soon, people began trading the receipts themselves instead of the actual gold. The receipts became a form of paper money, Accepted because people trusted the goldsmith actually had the gold to back them up. And right there, with those goldsmiths, a revolutionary and potentially risky idea was born. What if you didn't need all the gold to back all the receipts? The goldsmiths noticed that not everyone came to reclaim their gold at the same time. They began to realize they could issue more receipts than the gold they actually held, in the form of loans, earning interest. This created new money based on debt, backed by only a fraction of the actual gold. This very insight would fundamentally change the financial world, leading directly to the banking system we have today. This was the seed of fractional reserve banking. Part 3. The illusion of paper. How modern banks create money. The gold standard sounded great, but it also had problems. A nation's economy could only grow as fast as its gold supply. What if the economy needed more money to fuel growth, but no new gold was found? The money supply became rigid. Maintaining large gold reserves was also costly and difficult. Governments also found it restrictive. In times of war or crisis, they couldn't easily increase spending because they were limited by their gold reserves. The golden handcuffs sometimes prevented them from stimulating a struggling economy. Furthermore, a country might not be able to insulate its economy from recessions or inflation originating in other countries. Remember the goldsmith's trick of lending out more receipts than the gold they held? Banks adopted this model, formalizing it into fractional reserve banking. The core idea is this: banks realize that on any given day, only a small fraction of depositors actually come to withdraw physical cash. So, regulators allowed banks to hold only a fraction of reserve of their deposits in cash or at the central bank, and lend out the rest. Let's say the reserve requirement is 20%. This is where things get mind-bending. When a bank makes a loan, it usually doesn't hand over cash. It creates a new deposit in the borrower's account. This new deposit is essentially new money. Consider this example: you deposit $1,000 into a bank. The bank keeps 20% to OO as reserves. It lends out $800. The borrower uses that money to buy something, say real estate. The seller of the real estate receives the $800 and deposits it into their bank. That bank keeps 20% 160 and lends out 640. That $640 gets deposited. The bank keeps 20% 128, lends out 512, and so on. This cycle repeats. The initial $1,000 deposit can support the creation of multiple times its value in new loans and deposits throughout the banking system. This is the money multiplier effect. With the 20% reserve ratio, the multiplier is 10.2 equals 5. So, the initial $1,000 could theoretically lead to a total of $5,000 in the money supply 1000 original plus $4,000 created through lending. This 4000 of new money isn't physical cash printed by the government. It exists as digital entries in bank ledgers, backed by the debt of the borrowers. It was created by the very act of lending. Think about that. The vast majority of money in our modern economy is not created by the government printing physical cash. It's created by private banks when they issue loans. In essence, most of our money supply is digital debt, circulating as numbers in computer systems. The bills we hold are effectively IOUs, debts drawn from the future. This system allows economies to grow faster than under a strict gold standard. It provides capital for businesses and individuals. Banks act as intermediaries, channeling savings into investments. But it relies heavily on trust. What happens if everyone tries to withdraw their digital money at once? The bank doesn't actually have all that money. This is the inherent weakness. Part 4. The golden anchor breaks and modern instability. Gold standard, already weakened by wars and economic pressures, faced its final crisis in the late 1960s and early 70s. The United States, financing the Vietnam War and social programs, had created far more dollars than it had gold to back them. Other countries, holding large amounts of US dollars, grew nervous. They began demanding gold in exchange for their dollars, rapidly depleting US gold reserves. France even sent warships to collect its gold, facing the risk of defaulting on its gold obligations. President Nixon made a shocking announcement on August 15, 1971. The U.S. would unilaterally suspend the convertibility of dollars into gold. This Nixon shock effectively ended the Bretton Woods system and the last vestiges of the gold standard in international trade. Since then, the world has operated on fiat currency. Fiat means by decree. Fiat money like the US dollar, euro, yen has value simply because the government declares it legal tender and people trust it will be accepted in exchange for goods and services. This gives governments and central banks enormous flexibility. They can increase or decrease the money supply to manage the economy. Fighting recessions, controlling inflation. Tools like adjusting interest rates, reserve requirements historically, and now quantitative easing QE and quantitative tightening QT are used. But this flexibility comes at a cost. Without the gold anchor, money creation is less constrained, potentially leading to inflation, where your money buys less over time. Look at the purchasing power of the dollar since 1971 has plummeted. The system remains vulnerable to crises. The reliance on trust in the fractional reserve model makes it susceptible to bank runs. A bank run happens when depositors lose faith in a bank's solvency and rush to withdraw their funds simultaneously. Because the bank only holds a fraction in reserve, it cannot meet all demands and can collapse. We saw this with Northern Rock in the UK in 2007. Fear, fueled by news reports, caused panic, even though the initial problem was more about funding liquidity than bad loans. Lehman Brothers in 2008 wasn't a traditional deposit run, but a run in the wholesale funding market. Other institutions lost confidence and refused to lend to them, triggering a liquidity crisis and the largest bankruptcy in US history. Its collapse sent shockwaves globally. And most recently, Silicon Valley Bank's SVB in 2023. A combination of factors: interest rate risk on its bond portfolio, uninsured deposits concentrated in the tech sector, and the rapid spread of information via social media led to an incredibly fast bank run, withdrawing billions in hours. It showed how vulnerable modern banks can still be. Understand this. In the United States, since March 2020, the required reserve ratio has been 0%. That textbook money multiplier we just discussed? Legally, it's infinite. Banks are no longer required to hold any reserves against deposits. Their lending is now primarily constrained by other regulations, like capital requirements to absorb losses and, crucially, by the interest rates set by the Federal Reserve, the Fed. This gives central banks even more direct control, but it also highlights how far we've moved from any tangible backing for our money. Control now relies on interest rates and market interventions, not reserve ratios. Part 5. Bitcoin, the digital response, but flawed. In the aftermath of the 2008 financial crisis, a mysterious figure or group known as Satoshi Nakamoto published a groundbreaking paper, Bitcoin, a peer-to-peer electronic cash system. The goal was radical: create digital cash that could be sent directly between users P2P, without needing a bank or any trusted third party. Nakamoto identified the core problem. Reliance on intermediaries increases costs, causes delays, and introduces censorship risk. Bitcoin aimed to solve this using cryptography and a distributed network. The core innovation is the blockchain, a public, distributed ledger recording every transaction. Transactions are grouped into blocks to add a block and prevent fraud like double spending the same coin. Bitcoin uses a consensus mechanism called proof of work (POW). Powerful computers, called miners, compete to solve complex mathematical problems. The first one to solve it gets to validate the next block of transactions and add it to the chain. This work makes the chain secure and tamper-proof, as changing past blocks would require redoing an immense amount of computational work. As a reward for their effort and electricity costs, miners receive newly created Bitcoin and transaction fees. This incentive mechanism secures the network. Bitcoin proved that decentralized digital money was possible. It offered a way to transfer value globally without censorship. However, challenges quickly emerged, causing it to deviate from the original P2P cash vision: energy consumption, proof of work is extremely energy intensive. The Bitcoin network consumes electricity comparable to entire countries. This has significant environmental implications and makes mining expensive. Scalability and speed. The PoW process is slow. Bitcoin can only handle a small number of transactions per second compared to traditional payment systems, making it impractical for everyday purchases. Centralization concerns. Despite being designed for decentralization, Bitcoin mining became dominated by large mining pools with expensive and specialized hardware ASICs. This centralizes power and goes against the original spirit. Accessibility and cost. Mining Bitcoin is now out of reach for the average person due to hardware and energy costs. Buying Bitcoin can also be expensive and volatile. Due to these limitations, Bitcoin's narrative shifted. Instead of digital cash, it's often viewed as a store of value like digital gold. People buy and hold it as an investment or speculative asset, hoping its price will rise due to its scarcity. Only 21 million BTC will ever exist. While it has value because people accept it and demand is high, its extreme price volatility makes it a poor short-term store of value and unsuitable as everyday currency for most people. It has become an asset class dominated by speculation and large investors. So, Bitcoin was revolutionary, but it didn't quite become the easy-to-use digital cash for everyone that Satoshi envisioned. Its technology created new barriers: energy costs, hardware costs, speed limits. It became more of an investment asset. The dream of a truly accessible, global digital currency remained unfulfilled. Until perhaps now. Part 6. Pi Network. Democratizing the digital future. This brings us to Pi Network. Launched on Pi Day, March 14, 2019, by Stanford Fiat, Pi Network began with a clear mission to build a cryptocurrency and smart contracts platform secured and operated by everyday people. The vision? To build the world's most inclusive peer-to-peer ecosystem and online experience, fueled by Pi, the world's most widely distributed cryptocurrency. The founders recognized the barriers preventing Bitcoin's mass adoption: complexity, cost, energy consumption. Pi was designed from the ground up to overcome these hurdles. Pi's biggest breakthrough? Mobile mining. You can mine Pi directly on your smartphone. But wait, isn't mining energy intensive? Not with Pi. Pi does not use proof of work. It uses a different, energy-efficient consensus algorithm adapted from the Stellar Consensus Protocol (CCP). This means mining Pi doesn't drain your battery or require powerful hardware. It's user-friendly and planet-friendly. So how does Pi secure its blockchain without energy-hungry PoW? It leverages social trust. Pi adapts the Stellar Consensus Protocol (CCP) system used by the Stellar blockchain. In CCP, nodes don't compete by solving puzzles. Instead, they form trusted groups called quorum slices. A node only agrees on a transaction if enough nodes it trusts its quorum slice also agree. Pi's innovation lies in how these quorum slices are formed. It uses security circles built by mobile miners pioneers. When you, as a pioneer, add people you know and trust to your security circle after 3 mining sessions, you are contributing to a massive and global trust graph. This trust graph, aggregated from millions of pioneer security circles, provides the foundation for the computer nodes running the Pi blockchain to form their own quorum slices and reach consensus securely and efficiently. Your trust relationships, affirmed daily by tapping the mining button, are your contribution to securing the network. This makes the network highly decentralized, potentially more so than Bitcoin's mining pools, and resilient against attacks, relying on collective trust rather than raw computing power. Mining Pi isn't about computation, it's about contribution. Pi uses a merit-based system where your mining rate increases based on your diverse contributions. Let's break down the current rewards. Base mining rate B. Every active pioneer earns the base rate just by confirming they are human and active by tapping the lightning button every 24 hours. This rate decreases over time as the network grows, ensuring scarcity. Security circle rewards S. This is crucial. By adding 3-5 trusted people to your security circle, you significantly boost your mining rate. Each active member adds a bonus up to 5 members, strengthening network security. This role is called a contributor. Referral team rewards are, as an ambassador, inviting new members increases your rate. You earn a bonus for each member you referred who is actively mining concurrently. This incentivizes network growth. Lockup rewards L. You can voluntarily choose to lock up a portion of your transferable Pi for a set duration, for example, 6 months, 1 year, 3 years. This commitment to the ecosystem stability rewards you with a significantly higher mining rate. This can be done before migration via settings and also after migration directly on the blockchain. App usage rewards A. Using applications within the Pi browser and Pi ecosystem also increases your mining rate. This directly incentivizes the creation and use of real utility for Pi, making the coin valuable. Node rewards N. Running a Pi node on your computer contributes to the decentralization and operation of the blockchain. Nodes earn rewards based on uptime, processing power CPU, and network connection open ports. Your overall mining rate is a combination of these factors, calculated based on formulas outlined in the white paper. It's designed to reward those who actively contribute to the network's health, security, and utility. Unlike early Bitcoin, where supply was highly concentrated, Pi aims for fair distribution. There is a maximum total supply of 100 billion Pi. Distribution, 80 to the community. 65 billion for all past and future mining rewards pioneers, nodes, etc. 10 billion reserved for ecosystem building via future Pi Foundation. 5 billion for liquidity pools to facilitate trading or utility. 20% to the core team. This portion vests commensurate with the community's mining progress, aligning incentives. The mining rate follows a declining model. As more people join and more Pi is mined, the rate at which new Pi is created decreases. This ensures scarcity over time while allowing for wide initial distribution. You might hear about KYC, know your customer. In Pi, it's critical. To migrate your mined Pi to the mainnet, the live blockchain, and actually use it, you must pass KYC. Why? Pi aims to be a network of real humans, not bots or fake accounts trying to hoard Pi. KYC verifies your identity using government-issued documents, ensuring fairness and compliance with regulations. The process involves submitting your ID via the Pi browser. It can take time due to the massive user base, but millions have already passed. Part 7. Why Pi is your opportunity. Journeyed through millennia of monetary evolution, from the limitations of barter, through the rise and fall of gold's dominance, to the complexities and vulnerabilities of fractional reserve banking and fiat currency. Bitcoin offered a brilliant glimpse of a decentralized future, but stumbled on accessibility and practicality. Pi Network emerges as a response, learning from the past, leveraging mobile technology and social trust to build what could be the first truly global, accessible, and useful cryptocurrency for everyone. Now, you might see criticisms online. Is Pi real? Why is it taking so long? Building something revolutionary, aiming to onboard tens of millions globally onto a new blockchain with real utility, is incredibly complex. The phased rollout, the focus on KYC, the enclosed network, these are deliberate steps to build a sustainable and fair ecosystem. Pi's value isn't just about speculation on exchanges. It's being built through its growing app ecosystem, its massive verified user base, and its potential to facilitate real-world transactions. The launch of the open network is just the beginning of unlocking that potential. Imagine a world where sending value across borders is instant and cheap, powered by a currency mined on your phone. Imagine accessing Web3 applications seamlessly through the Pi browser. Imagine a true peer-to-peer economy where value is created and shared more equitably. This is the potential Pi Network is striving for. Consider how these systems compare. Pi Network offers a unique combination: the accessibility of mobile tech, the energy efficiency that Bitcoin lacks, and a decentralized model built on community trust. The Pi revolution is happening right now, and you can be a part of it. If you haven't started, Download the Pi Network app. Use an invitation code if you have one. If you're already a pioneer, make sure you complete your KYC and mainnet checklist. Explore the apps in the Pi browser. Build your security circle. Consider running a node. This isn't just about mining a coin. It's about co-building a new kind of digital future. What do you think the future of money is? Let me know in the comments below. If you found this journey through monetary history insightful, please hit that like button, share this video with anyone curious about crypto, and be sure to subscribe to Pi from us for more deep dives into the Pi ecosystem. Thanks for watching, pioneers. Stay active, stay engaged, and I'll see you in the next video, where we'll explore how Pi coin is taking shape and value, and what heights it might reach.